Alright, so you're thinking of buying a house and you're wondering how much your down payment should be. For some folks, putting 20% down is really a stretch. But putting down less than 20% can cost you quite a bit and in a fairly short amount of time. Let's say we have two houses, both worth $200,000. The one over here puts down 20%. They borrow the rest at 5% interest for 30 years. So that will be... Principal and interest will be $859 a month. Now about that house on the right, they just put down 10%. Their monthly principal and interest comes to $966 a month. So already they're spending $107 more a month. But they'll be spending even more than that, and here's why. The less you put down, the higher your interest rate tends to be. So instead of paying 5% in interest, the house on the right is actually paying 5.5% interest. All right, more math. Right now their monthly payment has jumped again to $1,022 a month. That's $163 more than their neighbor. But there's more. If you don't have 20% equity, that's the slice of the home's value you've actually paid for yourself. If that slice is less than 20% of the home's value, the lender will require private mortgage insurance, or PMI, as protection for them in case you decide to walk away from the home. PMI usually runs between $50 and $100 a month. In our case here, the people on the right are now paying $244 more a month than the 20% family on the left. And that means, sure, they put $20,000 less in a down payment on the home, but they paid that much extra in just 7 years, with 23 more years to go on the mortgage. 20% down may not be possible for everyone. Just go into it with your eyes open. Remember, subscribe, like, and share so your friends can be smart about their money too.